we have only a hour to give time on this topic. I have uh, already got the financial model done. We will try and understand the nitty-gritties and basically how, if we have to develop a model, what are things that we need to keep in mind, right? So this is a three-statement model that I would be going through. Uh, Basically, cash flow, balance sheet, and income statement. These three statements, we have a historical 5-year uh, past 5-year data for these three financial statements for a company. How we develop it is what we are going to look at into, right? But before that, the key important things that once we do financial modeling, uh, the things that we need to keep in mind is that when we develop the model, we need to keep a check on the referencing, right? So referencing, by referencing, I mean we have to input values if they're already somewhere in the sheet, right? We need a link of that rather than entering those values, right? So if there is last year's sales was 1,000 crore and we are looking at next year's sales growing at 10%, we will use that 1,000 crore rather than typing 1,000 crore and then inputting 1,000 plus 10%, right? So referencing is important. Within referencing, absolute and mixed referencing, right? Where we put a dollar sign, right? If one has the understanding of where to put the dollar sign, that makes the worksheet very efficient, right? It saves so much time if we have the understanding of when we need to put the dollar sign in front of a row, when we need to put the dollar sign in front of a column. Right? Just to start with, if let's say a simple thing that we need to calculate is we need to calculate the amount through a compound interest formula, which is principal into 1 plus rate to the power time, right? This is the compound interest formula, right? Let's say we have a rate written here, right? And in this column, rate, let's say our rate is 12%, right? I hope this screen is visible to everyone, right? Okay, rate is 12%. We have got time and principal as two variables here, principal and time. And in this column, we want to calculate the amount, right? Now, principal is, let's say, 12,000. In first case, 1,12,000. Next case, it's 25,000. And in the third case, let's say it is 1 lakh, right? So we get three values here. Time is 4-year, 5-year, 4, 6, and 5 years, right? What would be the amount here? So the simple formula is that principal, we link it the principal, use the multiplication sign, put a bracket, 1 plus the rate of interest is 12% here, close the bracket, to the power 4, right? This should give us the amount, right? Now, this is good if we have to calculate the value in only in this cell, right? So we get the value 18,882, right? But if we want to calculate it in next cell, and there are multiple cells here, right? If there are multiple cells here, what we will observe, if we copy this formula down, it will become B23, C20, and C23. These specific cells, if I copy the formula down here, we are not going to get the desired result, right? Because the value is now B23, C23, and C20. Now the C20 cell is empty, right? This cell, C19, has moved down to C20. Now, what we could have done here is we could have just placed the dollar to fix this row. Because we are copying the formula down, we need to fix the row, right? In C19, we need to put a dollar in front of 19, right? Ideally, if we put dollar in front of C and dollar in front of 19, it will also work. But for the understanding sake, we need to put a dollar in front of the row number. We want this row, 19th row, to be fixed, right? If I take it down, it should remain C19, right? In the next cell, in the next cell, in the next cell, right? So let's see. Now, if I copy this formula down, what we are observing is that we are getting the reference of this 12% all the time, right? Why? Because we have put a dollar here, right? Now, if this same scenario, right, I will now show a different case, right? I'll just copy these values, put it here, take a transpose of these, right? So all TS, and I will transpose these values here. So now I have got principal in a row, time in a row, and then I am calculating amount here, right? Now, what is going to change? My formula here is this principal value 12,000 multiplied by bracket open 1 plus the rate of interest 12% is there in the cell C19 and we go to the power 4, right? Now, I have to copy the formula to the next column. In this earlier example, I am copying the formula in the next row. Now I am copying the formula in the next column, right? So all I need to do here, I want this C27 to become D27 in the next column. I don't want this C19 to change to D19, right? I want C19 to remain C19, right? And C28 to become D28, right? So now I will fix the column because if I now copy the formula, this C will become D, right? The reference cell will move from this 12% to this cell. Earlier, when I was copying it down, it was moving down into the next row, right? So all I need to do is now is I fix a dollar here, right? I put a dollar here. And now if I copy this formula, I will get the desired result, what I want, right? So in both the cases, my answer is same. The difference is that I have put a dollar sign in the first case when I have frozen the row, and in this second case, because I was copying the formula across different columns, I have frozen the column, right? So this is one key aspect. When we do the financial modeling, we want these things to be very quick, right? So once we have the understanding of where to put the dollar, things become very easy for us, right? So in this case, if I have to copy the formula down and I have the same reference cell for one of the values, I will fix the row. If I have to copy it to next column, I'll fix the column, right? So one of the key things when we do modeling is this absolute and mixed referencing. Then in financial model, we often, when we are projecting the values for next 5 years, we will use growth rate, right? When we use growth rate, right? So next year's value is equal to previous year's value, right? Is equal to previous year multiplied by, again, we use the distributive property or associative property of Excel of maths, 1 plus the growth rate, right? And that's how we calculate the value, right? Next year's value is equal to previous year value into 1 plus the growth rate, right? So we will observe it when we look at the Excel sheet. This is the formula that we are going to use, right? So we put growth rate somewhere and 1 plus the growth rate. We will not use previous year's value into plus previous year's value into growth rate, right? We ease our operations by using 1 plus growth rate. Then there is another frequent thing that we are going to use is margins, right? Let's say we want to calculate capital expenditure as a percentage of sales, right? So we will be dividing one value with the sales, right? Whatever the matrix that you are using, we will divide it by one value for that specific year, right? So margins, when we use margins, we divide the value by sales, right? So our benchmark or our value which will guide our future values is going to be the sales, right? So sales would be in the denominator and there will be some other value in the numerator, right? This is how we will calculate the margins, right? This is how we will calculate the margins, which we're just going to observe, right? Okay, now we want our model to be a little, we want our model to have a lever where if we change the growth rate from 10% to 12%, things should automatically change, right? So for that, we will have a nested if. We often use if function in Excel, right? We will use if, within if, one more if, and then we will impute the values. So we'll create a scenario for our growth rates, right? So nested if function. Okay. One other thing that one needs to observe when is creating a financial model is there needs to be a same format across the sheets, right? So if your year 2026 is in column I in one sheet, it should be the same column I in second, third, fourth, fifth, sixth, seventh sheet, right? So we create one sheet and then we copy the the structure of that sheet into the next sheet, right? So we will observe this when we look at the model itself. All the places, the format should be the same, right? No confusion. H column would be 2026, 2027, right? If you are not observing it, there is some mistakes that we have done, right? Then there is a circularity because our model will have a circularity. Our balance sheet will match because we will calculate cash from the cash flow statement and then link it to the balance sheet, and our balance sheet should therefore match, right? So there is a circularity established. One value changes, the other value changes, and the entire worksheet changes, right? So when there is a circularity, there are certain caveats that we need to follow, right? We will look at those also. There has to be a standard color scheme when we create a financial model. So for example, when we hard-coded values are inputted, right? When hard-coded values, we use a blue color, right? Blue color to input. When there is a link, we use green color. When there are formulas, we use black color, right? So this is the international norm for financial modeling. Most of the investment bankers use the same model. For formulas, black color. If there is a linkage, green color. When the values are manually inputted, they are in blue color, right? So that is the color scheme. Also, all those estimated values are, or the forecast values are in a yellow background, right? So to differentiate that, okay, these are the forecast values, right? So this is the basic premise that we are going to start with, right? Now, let me just take you to the first statement, that is the income statement, right? Now, this is a model which is created based on these first 5 years values, which are actual values, and these are all estimated values, right? So what we have used, H column is 2025, right? And they are in yellow color, which indicates that they are estimated values, right? Now, how have we calculated the sales? So for every or most of the line items, we have gone into a different sheet, right? For the sales, we have moved into a sheet called revenue buildup, right? So in revenue buildup, we have basically all these data is coming from the company's published annual reports, right? So we have gone through the annual reports, taken out the specific values, hard-coded, inputted them in our worksheet, and then worked to calculate the next year's value, right? So in this sales, we have used growth as the benchmark, right? So growth over previous year. So if you look at the formula at one of these cells here, right? What is the formula here? The formula is the current year's value divided by previous year's value minus 1, right? The growth rate, right? So 1100, if current year value is 1100, previous year is 1000, the growth rate is 10%. 1100 divided by 1000 minus 1, right? We get 10%. That is the growth rate formula that we have used here, right? So we have calculated these growth rates for sale of manufactured products. Then there is a customer loyalty program and other operating revenue. So these three are the breakups of the sale, which we have observed in the annual report. It is mentioned under a certain note, right? And we have gone to that note and got these values. Once we have got these values, right, we have got these percentages calculated. Now we have also created in this sheet, we have created a scenario, right? Our scenario is, we have taken three scenarios, right? One with a very high growth rate, one with low growth rate, and one with a base growth rate, right? So in this case, our growth rate is a base case scenario, right? So let's look at this value here in this blue cell here, right? I will change this base case. I will change this base case to bull case, and my value changes to 11.85%, right? And if I change it to a bear case, my value again declines to 7.65%. Now, here I have developed scenarios here in these three rows here, right? These three rows, and then used actually I have not used the if function here. No, I have used the if function here, right? So nested if function, I have used, if the scenario here is bear case, then take the bear case value. If the scenario is bull case, take the bull case value, right? So we have used the if function to drive this scenario here, right? If I take it as a base case, my value becomes 9.65%. So basically, I have created scenarios where 2% higher than the normal case is bull case, 2% lower than the normal case is the bear case, right? And those values, if I take, let's say, if I take a bull case here, right, and I go up here, right, our growth rate for 2025 now is 11.65%. If I take it as a base case, it becomes 9.65%, right? So this cell here is driving the growth rate and therefore driving the values on the above it, right? So if the growth rate is 9.65% for sale of manufactured products, which is almost 100% of the sales in the next estimated years, right? What would be the sales? The formula here will be the previous year's sale again into 1 plus the growth rate. That gives us the sale of manufactured products for 2025. And similarly for 2028, the growth rate, the formula for the sale of manufactured product is previous year's value multiplied by the current year's growth rate, 9.65%, right? So again, in this scenario, we have taken constant growth rate for the next 5 years, right? We could have changed it here, right? But generally, when do these kind of modelings, we take a common growth rate for the next 5 years, right? When we actually work maybe in a equity research firm, we might change these values, right? But in the modeling case, we take the values to be same, right? So 9.65 and we arrive at these values. Then we take these values back in the income statement, right? So here, these values are linked from that revenue build-up sheet, right? So I have calculated that in revenue build-up and then brought it in this income statement is equal to revenue build-up HAT, right? So my value here is coming from the revenue build-up sheet, right? So 1, 2, 3, this done. Then we first step in our three-statement financial modeling is we start with this revenue, right? That is going to be the driver for all of our later financial modeling. This revenue is the key, which is important here. So we have figured out a way for revenue where we have also designed a certain scenario build-up, right? We can change the scenario. The moment I change here, the value in our income statement will also change, right? So now that we have created that income statement, this value, right, we come to the next sheet, which is the cost sheet, right? Now, again, the cost sheet, there are various costs: cost of material, purchase of stock in trade, changes in inventory, right? Then there is a employee benefit expenses and other expenses, right? So these five costs, the values are coming from our income statement. All these values are linked in that sheet, right? And you would observe they are coming in green color here, which clearly shows that they are linked to some sheet, right? So these values are linked to our income statement, right? Now, in case of cost, we don't use the growth rate matrix. Here, we are taking everything, every cost as a percentage of sales, right? So our matrix here is this cost as a percentage of sales. So for doing that, the first thing that we have done is we have introduced a line item here, which is the sales line item, right? We don't want to go to this income statement sheet time and again, right? We have introduced the sales item in this very sheet, wherein we have linked these sales to the income statement, right? For respective year, 2020, 21, 22, 23, 24, 25, 26, all these values are linked our income statement, right? So we have arrived those values here. Then once we have linked the historical value, we then calculate their value as a percentage of sales, right? So the general formula is this value. Again, now we are going to use a dollar sign here, right? Every time, because every time, right? In this case, this is 5901 divided by 1159. Two rows below, this is purchase of stock in trade divided by sales. Again, changes of inventory divided by sales. Again, employee benefit expenses divided by sales. So everything gets divided by this specific cell in this column, right? So for that, what we have done is we have introduced C12 divided by C$9. Again, C$9, right? Now, what it does is, now if I were to, let's say I remove this here, right? It will cause a lot of changes in my sheet, but let's say I delete it here, right? Now, if I copy this formula, right? I'm not doing anything else. I have created a formula in one of the row. I copy it and bring it in this cell and I just paste it here, right? What is the formula here? The formula here is C12 divided by C$9, right? So if I take it down to this C16, it should become C15 divided by C$9, right? Here in this cell, it should be C15 divided by C$9. Let's see. I will copy this, all these, and paste here. That's it, right? And I have got my things working here. So once I create this formula in this row, I will just copy it, right? I will copy it here. Then I take my cursor to this cell, right? Keep it here. Click on the Control tab in my Excel sheet. Keep the cursor here in the next cell, right? And in the other expenses also. So I am simultaneously inputting the same formula in 4 different rows, right? I am avoiding that repetitive process of copying it, pasting it. I have copied it, created the formula in one sheet. I am copying it to 4 sheets and enter, right? And I have got all my things working here, right? So again, the formula is working here. Okay, now that, let's say if I have created these 4 values, these 5 years of percentage of cost of material of sales, right? Now, in the 5th year, in the estimated year, right? This yellow column is estimated year, which is the H column where my 2025 values are, right? Now, I will figure out what is going to be the cost as a material, cost of material as a percentage of sales, right? So I have used the last year's value. So this is the last year's value. I have taken this value here and use this as a driver to calculate the value, right? I have used it as a driver. Again, if you would go down here, I have created that same thing here, right? The various scenarios, right? So if it's a bullish case, base case scenario, 51.1%. If I change it to bull case scenario, my cost should come down. If I make it a bear case scenario, my cost should go up, right? Which is what is happening. 52% cost as a percentage of sales in bear case. And if it's a bull case, it becomes 49.5%. When I make it a base case, the value becomes 51.1%, right? So for all of these line items here, we have created different scenarios, right? Of all the three values, we have created different scenarios. And then using this cell as a driver, I have linked this cell here and created these values, right? And then once we have got them here, right, we just go and link it to this cell here, 51.1% as the cost of material. When we change this scenario to a different case, right? If I change it to bull case, this 51.1 value will change, right? And all my cost will automatically change. If I change it, all my cost will also change here, right? So my cost will change here. And it will spread through across these rows, right? All the values will automatically change, right? Now, if I have got this as 51%, right? What would be the value here, right? Let's say I don't know what is to be done here, right? So I have removed those values. The formula here should be, right? Now we have figured out 51.1% is the cost of material as a percentage of sales. We know the sales. So we take this value and then multiply it with the sales, right? While doing it, I will also use a dollar here. I will fix the row of that sales, right? So I'll put a dollar here for sales, and then I will copy this formula till here, right? If I have got these values already inputted, then I can just copy this formula here, right? And paste it in this cell, this cell, this cell, and this cell, right? In one shot, I am inputting the formula in 5 different rows. Why? Because I have used a dollar sign. Otherwise, I will have to use 5 different iterations to put the formula here, right? So I've just used a dollar and inputted the values. I'm getting the same desired result, right? So once we have calculated these costs, we take these costs and bring it back to our income statement, right? So our next 5 years costs here are getting derived in that cost sheet, right? And cost sheet is getting derived through the sales, and every line item as a percentage of sales historical value. We either use a bullish scenario or bearish or a base case scenario, arrive at these values, then link these values in our income statement, right? So now that we have done this, we have created our income statement up till EBITDA level, right? So we have got these costs, we have got the sales. Therefore, we can now calculate the earnings before interest, tax, depreciation, and amortization, right? Then we will calculate depreciation, interest, other income, right? And the various other values, right? So there is some problem coming in here, divisional error. Why? Because I have changed a certain value, right? Let's see. Let's go to those values and figure it out, right? So now we are in one of our other sheet, balance sheet, equity and liability side, and then we are going to our assets and liability side, right? Now, this divisional error, which is coming here, right? This divisional error is now my balance sheet is not matching, right? In earlier case, it was matching. We will figure it out why it is happening, right? Okay, now this balance sheet, we will again break this balance sheet into various parts, work on it in different sheets, and then bring the values back in this sheet, right? So my income statement, this interest expense is the one which is causing problem here. Till the interest expense, everything is fine. This interest expense is causing a problem, right? So we will have to change certain things here in one of the sheets, and it will automatically take care of it, right? Let's see. Okay, so balance sheet, we come to balance sheet. The first item of the balance sheet is equity and then working capital and other long-term items. These are 3 or 4 values that we are going to calculate. So first, let's go to the equity sheet, right? So equity sheet, here it is going to cause a problem here. Okay, so what we do here is, for the time being, right? For the time being, I will delete this column, right? So interest expense, I would delete, and my balance sheet is now working fine, right? Once I have figured out what is the change here, we will bring back the values here, right? This line item was causing a divisional error, which I have removed, and now it is working fine, right? Now let's come to the equity sheet. And in equity sheet, the premise here for our equity sheet is we are going to calculate the dividend payout ratio for the past years, use that as a benchmark for our future years dividend payout ratio, and calculate the dividend based on the company's sales and profit that we have created. So in our income statement, till now, we have already calculated what should be the profit, right? So we will use this profit item, right? We will use this profit item to calculate what should be the dividend payout in next year, and on that dividend payout, what should be the equity value, right? So let's come to that sheet. Now, in this sheet, we have got income, which is the net profit, right? And below that, we have got, first we start with the previous year's equity balance. So this is what we are calculating, the other equity of the company in the balance sheet. This item we are calculating, other equity, right? This value we are going to calculate. So we come to this equity sheet. We start with the previous year's ending equity balance. Whatever the profit that comes, we will add it, and whatever is the dividend, we will deduct it, right? So before coming to 2025, let's go back to these previous historical years. We have, from the company's annual report, we have figured out what has been the dividend that the company the 5 years, right? We have also known what is the profit of the company during those 5 years, and we have figured out what is the dividend payout ratio. Dividend as a percentage of the net profit, right? And we figured out 31% in first year, 153, 118, 58, and 81.25, right? So many a times when there is a large difference in these numbers, we remove the outliers, right? And take the average of balance of those values, right? So in this case, we have taken the average of all these values, right? One of the very interesting aspect was that for this company, which is a FMCG company, fast moving consumer goods company, Britannia, in the year 2020-21, right, when most of the industry was suffering, they had their sales had nosedive by 10, 20, 30%, right? This industry, FMCG industry, didn't do that badly. In fact, it was performing better, right? Right. So in this year, they made better profits, and they therefore had a very high dividend payout ratio, right? So we have not taken it out. We have taken the average of these 5 years, which comes to 88%. We have calculated that 88% as a dividend payout. We have fixed that 88% for all future years for the next 5 years. Then we have gone back to our net income statement. Again, this value is coming from, this is also a linked value, I'm sorry. This value should have been in green color. This value is coming from our income statement, right? These values. And this is the derived value. What would be the dividend next year? The dividend next year would be 88% of 2122, which is the profit next year. That is the dividend, 1888, right? Now, if this is the dividend, this is how the equity at the start of the year was, right? Round about 4,000 crore. We made a profit of 2,100, but we paid 1880 as dividend. Our ending equity therefore becomes 4159, right? Now this ending equity becomes the beginning equity of next year, which we then link it to this cell. this beginning equity in the year 2026 is linked to the ending equity in 2025, right? And again, in this year, we made a profit of we would make a profit of 2312, which is our estimate. So we calculate, we add that, but we will then have a dividend payout of 2048, which we will deduct, and therefore we arrive at a ending equity of 4429.9, 22.9. And similar manner, we have calculated the values for all these 5 years. Now, these values take back again in our balance sheet, right? So our balance sheet, these values are linked to the equity sheet that we have worked in, right? So our balance sheet is now started getting built up. We start with first with the equity sheet, right? And then we will move to the working capital sheet. Now, working capital in our consideration is the current asset and current liability. In the current asset, we don't consider cash here because cash we will use as a derived value in the cash flow statement. And in the current liability, we will not use the short-term borrowings. Here, we will derive it in a different sheet, right? So there are two differences in current asset and current liability. In current asset, we are not including the cash here, cash and bank balance. And in the current liability, we are not using the borrowings here, right? Now, again, we have linked these values from our balance sheet, historical values. For these past 5 years, we have got the net sales and we have got a cost of sales here. Cost of sales is basically the indirect, the direct cost we have used here, these direct costs, right? Okay, and then we have calculated the net working capital, which is the difference between the current asset and current liability. And then later on, whether this change in working capital will cause a positive cash outflow or it will cause a cash inflow, right? For that, we have used the formula here, which is the difference between the net working capital of 2 years. Previous year's net working capital minus current year's net working capital. Right now, the presumption here is if our assets increase, right? If our assets increase, they are going to be negative for cash flow, right? If our assets increase, they are going to reduce our cash flow. If our liabilities increase, they are going to add to our cash flow, right? So this line item here is the net effect of change in the working capital. All of these line item of working capital, right? How they will influence the cash flow, we have calculated in this one line item, which is previous year's net working capital minus current year's net working capital, right? And we observe that in all our future forecasts, this is going to be a negative value, right? Again, for all of these values in the working capital, we have got one, most of them are as a percentage of sales, right? So we calculate the percentage of sales for 5 years, then use either an average or last year value, right? So here we have inputted a note here, which mentions whether we are using an average or whether we are using a last year value, right? So if I take my cursor to this cell, there is a purple color patch here. When I take my cursor here, it mentions average of 5 years. So in this row, I have taken these current investment as a average of last 5 years, right? If I go to the next cell, right, in this cell here, right, I would observe again an average of 5 years. If I go below, again an average of 5 years. One of these places here might have the last year's value, right? So I can clearly mark it here where I'm using average, where I'm using last year's value, right? Sometimes it is confusing for even the one who has created the sheet that what is the logic I have used. I have used the average here, I have used the last year's value, right? So if I mark it here, what is the logic that I am using? I'm linking it to previous year, I am using the average, right? So in this case, I am used the average. In this case, I have not used the average, right? So I have linked it to previous year, right? clearly, because it's also a green color, I have shown it as a green color, that it is linked to a previous year, right? Okay, this is done. Then the next important step in this sheet is calculating receivables as a number of days of sales, right? So instead of calculating receivable as a percentage of sales, we are using as a number of days of sales, right? First year it is 10. How we calculate it is receivables divided by average daily sales, right? So sales divided by 365, we arrive at average daily sales, and receivables divided by average daily sales give us the number, right? So for this company, the receivables were 10 days, 7.5 days, 8.57, 7.37, 8.56, right? So for future years, we have just taken the average of these 5 years and used those 5 years average to go and calculate the next year's value, right? So 8.35 is the average here, and later on it is linked to these previous years. Now, if 8.35 is the number of days of receivables in 2025, 8.235 is the number of days of receivable in 2025, what would be the absolute term trade receivables, right? That is what we need to calculate and take it into the balance sheet, right? So let's come to this cell here, right? Let's remove this value here, right? So how do we calculate this, right? Trade receivable. I know trade receivable is 8 days of my sales, right? So I go up, right? Go to sales divided by 365. So I now know the daily sales, and then I multiply it with the number of days of receivable that I have calculated here, which is 8.35, right? And I enter it, I figure out my trade receivable is 420.41. Similarly, for the next few years, once I have calculated this, I can then drag this formula down, right, into the next column, right, and I will get those values automatically, right? Once we are clear on where to put a dollar in front of row, where to put a dollar in front of column, where not to put a dollar, we can just straight away copy the formula and drag it into the next column, right? Which we can easily do and nothing will change, right? So we have done this. We have completed this working capital sheet now, right? Now, again, we will link these values into the balance sheet, back into the balance sheet, right? So we go to balance sheet and we link these values, right? So let's go to one of the current liability items, which is this value, which is coming from our working capital sheet, right? So all these values are coming from working capital sheet. One of the other thing while designing these sheets is when we are designing these working capital, we generally follow the same order of these naming order, right? So if it's current inventory, current investment, inventories, trade receivables, short-term loans, other current assets, same order is there in our balance sheet, except for the fact that there is a cash and also in our current asset side, which is not showing here, right? But the order is same, right? If the order is same, that reduces a lot of hassles in the later on stages, wherein we have to be very observant how we are going to link the values, right? Here, if I have got this value here, I can just copy it to the next cell, because I know the formula is going to get linked to the next row in the balance sheet, right? That's how we work it here, right? So we have now got this working capital, which again we link it to the balance sheet, right? The current liability and current assets, we are linking it in the balance sheet, right? And then the next step is, one of the other steps that we take care of is we ensure that none of the item is left empty, right? We just ensure that we are taking care of all those items, right? So other long-term items, many modelers make them constant, right? Even if we are to make them constant, we will bring it in a different sheet and make them constant, right? I have used them, all of these line item as a percentage of sales, right? So in the bottom area here, we have calculated them as a percentage of sales, right? And then used reverse calculated using this percentage, I multiply it with sales and get these values, right? Now, what it does is when we are calculating the cash flow statement, it also eases my lot of my hard work of going into a specific line item and checking whether it is being incorporated in cash flow statement or not, right? I am doing it in separate sheets. This one line item is going to be, this one line item is the only one that is going in my cash flow statement, right? Not any of these different line items, right? I have made a line item here, change in net non-current asset, right? So net non-current asset is basically current asset minus current liability. If the current asset is higher, that means cash flow negative, right? If the difference between the 2 years, previous year it was higher, current year it's lower, that means cash flow positive, right? Same logic which is going to get applied in the working capital, we are applying the same logic in this other long-term items also, right? So this 263.51 in 2025 is going to make my cash flow negative, right? Next year it is negative by 90, right? And similar values we will calculate, right? Now, so we have got the current asset and current liability and equity done in our balance. What is left is the fixed asset, right? Borrowings and fixed asset and borrowings are two of the items which are left there, right? Now, for those, we will then go to two different sheets. One is the amortization sheet, one is a depreciation sheet, and the third one is a debt and interest sheet, right? So first, go to depreciation sheet, right? Now, depreciation sheet, our depreciation is based on the capital expenditure, right? So if company is increasing the capital expenditure in the coming years, the depreciation is going to increase. If the company is not doing capital expenditure in the coming years, the depreciation is going to decrease, right? That is the premise that we are going to work on. Our depreciation is directly linked to the capital expenditure, right? And in most of these examples, we follow a straight line method of depreciation when we are calculating the depreciation for book depreciation, right? If we are using a depreciation to calculate for the income tax depreciation, we will follow the standard policy of WDV with the standard fixed rates given, which we take from the income tax website and use those rates to calculate the value. Here we are using straight line method, right? For straight line method, actually we are not even using straight line method. We are just taking capital expenditure, whatever the capital expenditure company has done historically, we take a percentage of capital expenditure as a percentage of sales, right? Our premise is if the sales are going to increase, the capital expenditure has to increase, right? If the company wants sales to increase in the future years, they have to increase the capital expenditure, right? Now, what is the capital expenditure as a percentage of sales? We calculate, we observe it has been 3.53, 1.08, 1.25, 7.26, 2.51, right? Now, this is practically the case when we do modeling, we take an average of it. Generally, when company would do a capital expenditure, let's say their capacities utilization have come to 80%, right? Now they will add one plant, which will increase their capacities by 25%, right? So in that 1 year, they will make a huge capital expenditure. Next 2-3 years, there will be just a normal maintenance level of capital expenditure, right? But when we do modeling, what we do not assume that the capital expenditure in future years is going to change, right? For example, in this case, we have taken 3.13% of sales as the capital expenditure for the next 5 years, right? Now, in practical, this may not be the case. In one of the years, it may be 9%. 1 year of the year, it may or 0.5%, right? That is how the practical thing will work one way. But when we do modeling, we take an average. So we have figured out this is going to be the capital expenditure. We already know what is the sales in these years, which we have calculated in our income statement, right? So we use that value, multiply it with this 3.13% to get what is the capital expenditure in future years, right? So let's say for this year, if the capital expenditure is going to be what is the sales in this year multiplied by the percentage of capital expenditure that we have forecasted for all these 5 years, right? So we arrive at 630.78, right? Similarly, for 5 years, we have calculated these capital expenditures. Based on the capital expenditure, we have also got the depreciation, which is again, we have taken it from the company's balance sheet. Now we take depreciation as the percentage of capital expenditure. Here we observe there are huge differences here, right? 157 here, 128 here, 24 here, 68 here, and 55% here, right? Now, the normal logic should be that we should remove these outliers, right? 157 and 58. But again, there is a 24% outlier, right? Now, if we remove all the outliers, there is nothing remaining here, right? So in this case, we have again used the average of all these values, right? And calculated that as a depreciation as a percentage of capital expenditure for future years. So in this case, we are not calculating the depreciation using straight line method. We are using a mathematical formula to calculate the depreciation, right? So if 87.18% is the depreciation in next year, the value would be what is the capital expenditure 575 multiplied by what is the depreciation 87.18, right? And we get 501.55. And we copy this formula for the next 5 years, we calculate the value, right? Now, this doesn't complete our work in the sheet. We also need to figure out what would be the fixed asset value in the coming year, right? So we start with the previous year's fixed asset value, 2602. We add whatever the capital expenditure that we have done, 575, and we reduce whatever is the depreciation here. So 2602 is what we have started with. 575 is the capital expenditure done in this year, and 501 is the depreciation in this year. So that gives us the ending asset value as the sum of these values, right? Now, one other thing which we generally use, we put a summation formula here, right? And to put that summation formula wherever we need to make the values negative. For example, in this case, this depreciation we have taken as a negative value. Instead of putting it a positive value and then deducting it here, we have used it as a negative value and then put a summation formula here, right? This is automatically summing up, but the depreciation is getting deducted here because we have used the negative value here, right? So all these values we figure out, we take it back to the balance sheet. Similarly, we do for the intangible assets, right? We have taken the amortization value. We have calculated what would be the ending net intangibles. These values, again, we have taken back to the balance sheet, right? So let's go to that balance sheet and the net block of fixed assets. This value is coming from depreciation sheet, right? This value is coming from depreciation. So now we are done with depreciation. We have done with amortization. That means we have done with fixed asset sheet, right? Whatever now is left is debt and interest, right? So let's come to that debt and interest sheet. One last item in our sheet, right? So we calculate that debt and interest. There are multiple ways to calculate this debt, right? We can also use a revolving credit or a long-term debt, take out the what is going to be the quarterly installment, and based on that, what would be the debt in the next year, right? In this model, what we are doing is we are calculating debt as a percentage of sales, right? So previous year's debt we have already got from the balance sheet. We have calculated long-term borrowing as a percentage of sales, and then we have taken an average of it. If 6.53 is the next year's long-term borrowing of the sales, the long-term borrowing would be the sales multiplied by this percentage, right? So we get this value. Similarly, for short-term borrowing also, we have used a same short-term borrowing as a percentage of sales. We have calculated those values, right? And we have calculated those values, reverse calculated, and taken these values to the balance sheet. Now, based on our long-term and short-term borrowing, right, we will be paying the interest to the bank. So here we have calculated the interest separately on long-term borrowing and short-term borrowing. And if we are keeping cash with the bank, we will earn some interest. So we have calculated that interest also here, right? And the summation of all three, actually, the borrowings, interest on borrowings we have added, and the interest on cash balance we have deducted. We have calculated those values and taken it back into the income statement, right? So this value now should be there in the income statement, which currently is not there, I guess. So this interest expense should come as is equal to minus, and we go to this sheet here, right? And we link this value, right? And we copy this formula till all the future years, right? And we observe our balance sheet is now again matching. Again, it is matching, right? When this is true, that means asset side and liability side is completely matching, right? The one thing which is left out is the cash flow statement, right? So only few items out of the company's published annual report are going to be put in our financial model. One is the profit before tax, then depreciation we add back, we take it from the income statement, add it here. Finance cost, which is the interest cost, we again add it back in the cash flow from operations, right? We arrive at this, we deduct the working capital change, which is linked to that working capital. We are not linking it from receivable, payable, and inventory. We have got just one line item here, which is the working capital, which we are bringing it from the working capital sheet. We arrive at cash flow, deduct the taxes. This is net cash generated from operations. In the investing activity, there is only the capital expenditure. So we deduct the capital expenditure that we have done, which we figure out from our depreciation and amortization sheet, right? And the changes in other long-term items, which again is from that one sheet, other long-term item sheet, right? Whatever the value, we link it here, whether cash flow positive or negative, right? And then this gives us cash flow from investing. Then we come to cash flow from financing. The one first thing where we are coming here is the dividend payout, which we have calculated in the equity sheet. We bring it here. This is the dividend payout. This is cash outflow. So negative side, right? Then if the borrowings are increasing, that means cash flow positive, right? So in this case, our borrowings are increasing over previous year. So cash flow positive. Finance cost, which we have initially added, now we reduce it in the cash flow from financing activity. We arrive at cash flow from financing. Then we figure out what is the net cash flow during the year. In all these years, it is in positive. That means our cash flow at the ending cash balance will keep on increasing, right? So we start with 446, which is in the cash in the previous year. We add this 446 to arrive at 902. And in the next year, we add this 183. And similarly, we are arriving at these cash flows. This cash at the end of all this is going to get linked back to the balance sheet here, right? This cash is now linked to this balance sheet. And the moment we do that, our balance sheet matches entirely, right? That's created a financial model. I would have wanted a little more time, but we are short on time. I'm sorry. So I've been just being able to run through how we do a financial modeling, integrated financial modeling, wherein this value. Okay, now let's go to this revenue build-up sheet and let's change this. Let's see what is our income statement showing. The profit is 28011, right? Just one more moment, sir. 22800.11 is the profit here, right? Now, if I change the revenue build-up sheet and make it as a bull case, right? I make it a bull case. I also make my cost sheet a bull case. right? And let's see if I do all that, right? If I made this a bull case and this a bull case, how that alters my profit. My profit has gone up to 4256.05 from 2800, right? So from that one cell in revenue and one cell in the cost, I have altered my all projection for future, right? When I go to this DCF modeling, based on this, our valuation will also have changed on this, right? We are not covering that in today's session. Sorry. So that's about it. My time. If you have any queries, please go ahead. Anyone, everyone.
Yes, dear participants, now you can raise the questions. You can unmute yourself and ask questions. Sir, there is a question in the chat. I think how to make this purple color text in, that is average of 5 years.
Purple color, average of 5 years. Okay. So let's say, let's go to that working capital sheet, right? Here we have done this purple color, right? So let's say I come to this cell, right? I am removing this note that I have written here. So I go and right click on this cell, right? I'll get something called as a comment. In previous version of Excel, probably it's a different thing. It is insert comment or edit comment, right? So if I want to delete a comment, I'm deleting the comment. Right now that purple thing is gone. If I want again, right? How we will do it? Right click it, right click here, and I will add a comment, right? In earlier Excel sheet, it is insert a comment, right? In the later version, this is a new comment. So new comment, I want 5-year average, right? So I write 5-year average here and I say go. That comment is coming in here, right? So this is one small tweak that whenever we are basing our financial model, we want to ensure that we at least know what is the basis here. We can write a note here, right? Which is not visible otherwise unless and until we go to that cell and keep the cursor there, then it is visible.
Thank you, sir. Any other question, participants? I think there are no questions.
No question, okay. More questions, sir.
Yes, sir. Thank you, sir. You nicely projected the income statement, cash flow statements, nice projection for the 5 years. And you came to know clearly how we can use the Excel for the purpose of projection clearly. That is the aim. Nicely you presented. And I think one of the members posted in the WhatsApp group, is it possible to share that sheet in the group?
Sure. I will share it with
yes, you can share it with me.
Yeah.
I will share in the group.
Right.
And thank you, sir. Thank you for your nice presentation. I hope everyone will enjoy nicely.
Right.
Thank you. We will meet tomorrow. Thank you, sir.
Thank you, everyone.